And of course, let's start with Nigeria. Of course, a lot of interesting activity over the last week. We've seen volatility. We've seen yields come down now. I think they're beginning to tick back up. But I think you make a very important point where you address the December auctions as the last opportunity for investors to get great yields in this market. Why do you think that? Are you anticipating that yields are going to come down going into next year?
Thanks, Wole. Well, what we've seen actually is that the bonds printed at very low levels in the primary market, then came back a little bit. So the 10-year is now trading at 12.4%. But the expectations for a more benign inflation environment and interest rate environment in 2013 will definitively push those yields lower. Maybe not immediately, because some investors are going to close their books for 2012 in coming weeks, and also because some of them want to actually take profit at this stage. But in early 2013, we think that actually those rates will fall further, and we actually think that the 10-year yield could reach 10% or so.
10%?
Yeah.
Wow, that would be interesting. Maybe people will start moving to Ghana because, of course, yields are very attractive there. Your thoughts on comparing Nigeria's risk to Ghana's risk? Ghana is offering yields around 19 to 20% these days. Nigeria is closer to 12%. How do investors approach these two markets in your view, considering the fact that we have those elections coming up in a few weeks?
Well, I think it's a different framework in a sense. I mean, Nigeria is an oil exporting country, so obviously the fundamentals are, in a sense, much more robust than in Ghana.
Particularly for the exchange rate, I guess.
Indeed. Although the exchange rate has stabilized in Ghana recently because of tight monetary policy. But when you look at the other fundamentals, like the current account or the fiscal position, obviously Nigeria is in a much better shape. Now, in the case of Ghana, we feel that actually the exchange rate has stabilized for now. We feel that the elections won't impact the effects on actually even the bond market, because in the secondary market yields have been pretty flat recently. The core scenario is still that in 2013 the government is going to consolidate public finances to some extent, and then the Bank of Ghana will start cutting rates. Now the bond yields currently at the 3 and 5 year portions of the curve are between 19 and 20%. So if those rates go to, let's say, 12–13% in a year or so, you have a massive duration trade, and I think that's really the key point here.
All right, very important point there. Now let's move on to Sierra Leone. I think very interesting market, and I think the first discussion here will be liquidity. You have the opportunity to get yields in treasury bills between 18 and 25%, but then in terms of liquidity, what risk are you taking there?
Well, basically, the amounts on offer are very small. Now, if you look at last week's auction, they sold $15.7 million for all T-bills. It's very marginal. But as you say, yields are very high. Monetary policy is very tight. The policy rate is at 20%, and that's because they had a fiscal slippage in recent years, less so recently. And so the central bank had to intervene to stabilize the exchange rate. And that's actually been pretty flat recently. The Leone has actually traded around 4,300 or so. Right. So on the political front, we don't think that the last election, which is currently challenged by the opposition, will impact the yield curve because there's no liquidity. But having said that, I mean, obviously, it's a difficult one because of the size of the auctions. If you take a big position, you basically work against yourself, in a sense, by driving the yields lower.
Interesting. Okay, now, Côte d'Ivoire, clearly one of the best performers, especially when you look at the Eurobond performance this year. And clearly there's been some interesting dynamics on the political front. But your thoughts on that? You are giving me the sense that, speaking earlier, that investors have overreacted to the changes we've seen in terms of the Prime Minister there. But your thoughts on the risk that Ivory Coast offers, and given the yields that are available now?
Yeah, I mean, it was very interesting because, 2 weeks ago, the president changed the prime minister and the cabinet, actually. So once the cabinet was dismissed, the market somewhat misread the news, and the bond lost, I think, 4 points or something like that, and traded down to 86, 87. It's now back to 92, 93, which means that actually that reaction didn't really make much sense. Clearly. And people have realized that actually the reshuffle basically meant that the president wants to have a more cohesive and forward-looking team. But we still feel that actually Ivory Coast is trading too wide versus other African Eurobonds. So the spread of the Ivorian Eurobond is in excess of 500 basis points over US Treasuries. You look at Ghana, it's 400. Look at the fundamentals between the two countries. Despite the perception that Ghana is stable, Ghana has a massive current account deficit, fiscal deficit, and so on, while in Côte d'Ivoire the situation is much...